Here's an unpopular opinion. Diversification won't actually save you or your portfolio. Most of the retail investment advisors out there today preach diversification. Most of the Wall Street firms preach diversification. The concept stems from Harry Markowitz and his groundbreaking paper that he wrote in the 1950s. He later expanded that paper into the full monograph. Now, most people in this industry know the talking points or the results or his conclusions, but I would argue very few people have actually read his paper, or certainly not his full monograph. If they have, they would understand some of the massive problems in the theory. This is the efficient frontier, and it's really the culmination of Markowitz's theory. Now, if this brief introduction resonates with you, plan on picking up a copy of my upcoming book, Evidence-Based Investing, which should be released soon. In the book, I go into a little bit more detail. But let's talk first about the problems, or at least a couple of the problems, with this theory. Before going any further, I want to stop and give credit to Markowitz because his dissertation truly was groundbreaking. He was trying to do the same thing that my team and I are trying to do. Trying to reduce risk while increasing return. So I don't have a problem with that theory. The problem that I have is that we have an abundance of evidence to suggest this theory does not work in reality. In short, Markowitz's theory postulates that by combining different assets into a portfolio, you can change the risk and return profile for the portfolio. As a simple example, on the screen I've got 4 stocks. He uses standard deviation as his measure of risk. This is one of the problems I have with this theory. I'll talk about that in a second. Then we have expected return. And so he demonstrates mathematically that by taking these 4 assets and putting them together, you can have a portfolio that has lower standard deviation or lower risk, but a higher return. Now, the first problem I have with this is that he's using standard deviation as his calculation of risk. The problem I have is that I've never met a single client that has a problem with top side standard deviation. They only mind it when they have bottom side standard deviation. In other words, nobody minds above average returns. Everybody has a problem with below average returns. Well, standard deviation counts upside and downside volatility as the same. That's problematic. The next problem that I have with the theory is that in order for Markowitz to get his math to work, he needed to assume that correlations were constant. Well, there is an abundance of evidence to suggest that correlations are anything but constant. So what is correlation? Well, correlation is just a mathematical way to compare 2 things to each other. So if, for example, we take a look at XLB and XLI, we have XLB here and XLI. What this 10-year correlation matrix is telling us is that these 2 sectors, the material sector and the industrial sector, have a very high degree of correlation to each other. One could argue that it really doesn't make sense to put XLI and XLB in the same portfolio simply because their correlation is so high, they're very likely to act in a similar manner. However, if, according to the theory, you added XLU to a portfolio of XLB, that should be a better portfolio diversifier so that in a time of crisis, theoretically, these 2 assets should perform differently. But did it work? So the answer is no, or at least not always. On the screen right now, we've got the performance of those 3 sector ETFs during the global financial crisis of 2008. So right when you needed diversification to help you, it failed you. This is just one example of why we measure risk differently. It's also a very clear reason why we manage money differently.